Let's talk a little bit about the big picture story, first of all. Then we'll dig into the earnings. It's been a really tough start to the year for big tech. Is this an opportunity for investors? Do you want to put money to work in this sector right now? What do you make of the price action?
Well, it has been, and the end of the year was exactly like the beginning of the year, which was difficult, especially for the high growth, high multiple stocks. And that's not been tempered by some of the action in the first few weeks of the year. I think we saw some stocks really get much lower than I think even some of the most bearish people expected the stocks to go. And that's what happens in these kind of violent rallies and violent contractions in stocks. I think the VIX is telling you that we're going to have more days like this. And I think you're also going to get an opportunities. I mean, Microsoft, frankly, is a perfect example of that, right? It's the most understood stock, let's call it that, as one of the highest, if not the highest market cap company in the world. And that stock's traded in a 10% range from the lows of aftermarket trading last night to right now. Think about that, 10% range for the most well-understood stock. That's problematic, I think, for the market in general, which is we want these to be a little more tempered. And days like yesterday and the last week are showing that we're probably more days ahead. But I think, again, the valuation umbrella for some of these stocks is intact. I think there's lots of capital on the sidelines. And I'm not talking about, people's investing and they're going to put a few bucks to work. Yeah. We haven't talked about private equity. We haven't talked about some of the people who swoop in here when valuations contract. And I think there's lots of that potentially on the sidelines. We just haven't seen that yet, which gives me confidence that the year is going to be just fine.
Well, but talking about kind of that valuation contraction, Mark, already the NASDAQ 100 is trading at a multiple of about 25 times, the lowest since May of 2020. That's still 30% above the 10-year average. How much further do you think we could see that multiple contraction?
I think the opportunity for the overall market to contract is high. What I also think is some of the less valued company, the lower valuation companies probably get a second look. And the companies that have been trading, frankly, at market caps to revenue that are infinite, because, again, profits are farther down the road, those will contract. We're going to see kind of the lower valuation companies, I think, go higher and some of the highest valuations stay lower. And that's a good backdrop for the overall market. It's never a good sign, in my opinion, when there's a small band of stocks that are doing extremely well and the overall market's doing poorly. Even before the last couple of weeks, half of the NASDAQ was down 50% from its high. It was hidden by the fact that the FANGs, I call it Mount FANG because I include Microsoft and Tesla, but it was hidden by the fact that those stocks held up until a couple of weeks ago. I think this is cathartic for the market, but these things take time and everybody likes a quick fix. There's no quick fix here.
What's the read across from Microsoft? Let's talk about that now in terms of the details on the earnings. What's the read across from Microsoft into the rest of the sector, Mark?
I think the read across is that the health of the economy and the health of technology is real. They're as good a proxy about corporate America, like you said, about cloud and some spend. It's healthy. The economy is getting better. And yes, we have this Omicron weight that's probably going to lift in the next 6 weeks. I thought the Pfizer CEO's comments were portended a much better back to work and back to normal marketplace. And that's going to happen through the rest of the year. We have so many more weapons that we're going to have to combat Omicron and get the supply chain intact. That's going to happen as the year progresses. That means that I think rates will start to dissipate, or the fear of rate rises will start to dissipate. The health of the economy will continue. The health of the global economy will continue. And I think that's great for the overall read. And Microsoft is as good a lens on that. And again, their report was just fine and their outlook was just fine. That's what was, I think, more important than anything than the printed number, because that's in the rearview mirror.
But on those outlooks, how good is good enough for some of these really richly valued tech stocks? How high is that bar?
It's really high. I mean, if you love the stock at 100 times revenues, why do you love it now that it's at 60 or 50 times revenues and profits are in the rear, or not even in the rearview mirror? They're not even in the mirror right now. That's the question for the market. And I think the richly valued, the profitless companies are getting repriced. But what I'm seeing from the investors that we talk to and some of the funds that we talk to is that they're ready, if these corrections stay permanent, to put more capital to work. Yep. And frankly, I don't think we've seen that yet, okay? I have walked and talked with a lot of portfolio managers over the last few weeks. I felt no fear from these people. In fact, I always say the market's getting close to a bottom when my mother calls me and says, "Are you okay?" Okay. So she called on Monday and she said, "Are you okay?" That kind of put a bottom into the market. These portfolio managers are ready. They're doing the work that they need to do if these stocks take another leg down. Because again, the fundamentals of the economy, what's changing the economy, the digitization, the fintech companies, some of the other things that we've talked about in the show have not changed one iota, despite some of the multiple compression that we've seen.
Another market indicator we now have to look for, Mark's mother and when she phones. Let's talk a little bit about some of those companies that you talked about having the potential to go down here. Microsoft has just stepped up to the plate on the M&A front. It is tricky for large tech companies to do that right now. Nevertheless, Kathy Wood talks about innovation being sort of on sale right now. Is there a potential for some of these big companies with a lot of cash, with a lot of potential to generate cash, to do some consolidation here? Can they go shopping?
They will. I mean, these are the most richly valued companies with the most cash on their balance sheet. And like you said, we saw a company get acquired for cash recently. I'm getting old enough where 2016 seems like a long time ago. But there was a time of year, this time of year in 2016, we called it Tableau LinkedIn Friday. Okay, both companies missed earnings substantially on those days. Stocks went down 30, 40%. The SaaS stocks went down 30 or 40%. And guess what? Microsoft stepped in then and bought LinkedIn. Tableau got purchased then too. Okay, I think we're going to set ourselves up potentially for that backdrop. That drawdown that time of year was more substantial than we've seen today. But the innovation is probably more substantial today. So obviously it hasn't happened yet. We've seen the rebound. The Nasdaq is up, 10% or so off the bottom from the lows of Friday. We will see that, okay? Because innovation never dies, and I think there's lots of opportunity for these big companies to buy these broken angels if that happens. And I think they're assembling their list. And that example of that acquisition is a perfect one for what we saw recently.